Hi there, everyone. So as the slide says, I'm Arthur Hughes Hallet, so I work in our FS disruption practice. So what does this mean? Well, apart from having disruption in my name or being introduced as the head of disturbance recently, which sounded slightly less impressive, I help our clients, which are mostly incumbents, think about what disruption is, what does it mean for them, and fundamentally, how can you predict it? How can you track it? What things should you be really interested in? And that's kind of what I wanted to speak about today, is the idea that there's three key things which I really wanted to focus on. So one, what do we think disruption is? Two, what do we think causes it? And three, where do we think it's going to hit next? So I've been here all morning. I've heard people speak about this quite a lot. And I think the retail banking example I have behind me is a really interesting example for disruption, and particularly from an opportunity perspective, as Jane mentioned earlier, is there's this idea, particularly within incumbents, that disruption fundamentally is a bad thing. It's a risk. And for me, disruption is an opportunity far before it's ever a risk, and our job is to help clients understand why that's the case. So if you look at retail banking, so this is within the UK, I really like this graphic. So you can basically see the regionality which has existed in the 60s within retail banking within the UK, and then gradually, over the next 50 years, we had this amalgamation of banks into what we now know as the Big Six. And for me, this was a little bit stifling from an innovation perspective. And actually, when it came to 2015, and you had the emergence of such things as Metro Bank, and then we got more towards the fintech level, you see actually the disruption created massive opportunities because fundamentally your customer base was changing, your customer value chain was changing, and what your customers wanted from you was changing. I think for incumbents and fintechs alike, this was a really exciting proposition. So first, when we started this piece of research, which we called the currency of collision, we had to go through two things. So number one, what we thought were the characteristics of disruption. So first, we thought it had to have industry-wide scale. So we decided this wasn't the ability that every time I get paid, my Alexa plays the song Money, 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 which I think is great. But that's not necessarily disruption because it hasn't really hit industry-wide. And so firstly, so industry-wide, so let's think what Vanguard did to the asset management industry, number one. Number two, there has to be a significant shift in profitability for the incumbents. So again, what are we talking about here? Let's think from a wealth management perspective. Let's think of the movement from active fund management towards tracker funds. And then finally, customers receive better value. So for me, this was the most important element of disruption. This is the Clay Christensen idea that you only serve the customer for the value they want to pay for. I think this is the really interesting thing. So again, when we think of an example about this, is think, okay, so what are the products? So robo-advice. So let's say I'm a 26-year-old, I've got $4,000 invested in my ISA. Do I need to be paying a person to help manage that ISA for me? Probably not. Happy with a robo-advisor, and therefore I'm paying for the amount of value I actually want rather than what that company has to offer. So those were the three characteristics. And then we had defined those. We obviously also need to think about who can disrupt. This is a fintech conference, so I guess everyone knew the answer to the first one. It's challengers. And then the second was incumbents. Again, we think incumbents have a huge part to play. And if you look at people like IAG in the past, even Direct Line Group, if you go back to the 80s, they disrupted the insurance market by selling it over the phone for the first time. Incumbents can certainly disrupt the market. And then finally, players from a different industry. So I was listening to a podcast last week where someone was hypothesizing on the idea that Amazon, from a lending perspective, might be one of the top 5 largest banks in the US, purely due to their trade finance. And that's fascinating when you consider that Amazon doesn't have a banking license. And yet they are one of the largest banks in the US. So I think for me, players from different industries can potentially be one of the biggest components of disruptors. And then, being good consultants, we came up with a framework. But I think the really interesting thing about this framework, and what we came to realize, is it's not necessarily about what you'd think it was. So we've heard a lot about technology, and we've spoken a lot about that today, whether it be blockchain, and that's normally what my clients ask me, first of all, come and talk to us about technology within financial services. Well, technology is just an enabler for disruption, and it's just one of the enablers. And in actual fact, it's those macroeconomic trends going around the side, which I think are the most important elements. And actually, it's these enablers going around, which I think are fairly self-explanatory, but I'll come back to them later, where I think all they're doing is catalyzing those fundamental macroeconomic trends. So let's go through, I'm going to quickly go through some examples of where I saw this taking place. So socio-demographic shift. So this is the idea that 25 years ago, people, so the people within the UK from the age of 25 to 49 outnumbered the people from 50 onwards by about 40%. Now, we're getting to a stage within 2 to 3 years where we'll have total parity within that number. Japan hit that number 10 years ago. China is scheduled to hit that parity number by 2030. So where's the opportunity here? I know that's what I came to speak about. The opportunity is this is a fundamental different market for stuff like life insurance. This is a fundamental different market for pensions. And we're even seeing this in pensions right now, and we're seeing this increasing in disruption within pensions, and we think that's enabled by things like the Pension Reform Act in 2015, increasing technology, you've got pension B, you've got so many people in this space. But it's that trend which we think is the most important thing, and the technology in place is just the enabler of that trend. And then if we get on to the next one, so this is climate change. Again, tough to see an opportunity here, but I think there is one. So this map is the 2018, every storm or climate incident in the US which is above 1 billion in value. So the cost of that was above 1 billion. And this is a serious concern for insurers. So climate-wise is an amalgamation of kind of 29 insurers, including Aon, et cetera, who are so worried about what climate change could do to their portfolio policies, they think it might cost them an additional 30 trillion over the next 11 years. I still don't really even understand how big that number could be. But where do I think the opportunity is here? Well, if you're a wealth manager, how can you get to the forefront of being the person who enables you to not only do no harm, which is this whole kind of ESG principle, which I think everyone's fairly familiar with, but actively use your investments to do good. And whoever gets there, and I'm still not sure we're there yet, will have a fundamental, advantage within this space in terms of how can you offer a product which helps people understand not only their financial return from an investment, but the social return from the investment, the environmental concern from the investment. So stealing that triple bottom line idea from Unilever, like how can you do this from an investment perspective? I think this is a massive opportunity. And then the next megatrend we thought about was economic stagnation. So again, what you're looking at here, I mean, these stats are a bit old, but I think this is still relevant. This is basically the extent to which people have got better or worse off over the last 30 or 40 years. And as you see, although the color scheme hasn't quite worked out, the numbers with 5 and 1 are in fact red, and the other one's orange. What that's saying is that hollowing out of the middle class, or the middle class are losing money. And why do we think this is the case? Well, one of those reasons is the movement away from public assets towards private assets. And if we take hedge funds as an example of following the money, they're always pretty good at making money. 56% of hedge funds in the US last year had investment strategies which were non-equity focused. So they were private focused. So again, where's the opportunity we see within this? For us, this is about how do you unlock the privatization of these assets for the public. So I think even companies like Cedar, they are allowing the public to invest in things which previously weren't investable. They were just the realms of the venture capitalists, which I'm sure some of these are in this room. But how do you unlock those for a mass market? And again, there could be a huge opportunity there. And then finally, political protectionism. So again, tricky to see an opportunity, particularly potentially if you're a global bank. But we see this in the news today. So this is the idea that what happens if Huawei is just the beginning? What happens if Donald Trump starts going after banking? And what's really interesting about that is the international currency is the dollar, and it's very easy to shut you out of the dollar. So, and again, we're seeing this in Russia right now. You're seeing innovations within the banking sector where you have people, rather than relying on the dollar as the international currency, moving towards the ruble or something else. So again, what? Or Bitcoin, exactly. So there's massive opportunities here. So yes, do I wish this wasn't happening? 100%. But does it still offer a fundamental opportunity? I really think it does. So what I meant to do by going through all of those was to say, I mean, obviously, those are not all the answers by any means, and these are just suggestions, but trying to kind of come against that theory, particularly within incumbents, that disruption is a risk. I think it's a huge opportunity. And for us, this is where, my first question was, why do I think it's an opportunity? And And my second question was also understanding, okay, so what are the enablers behind this? So the ones everyone obviously knows is technology, and we've spoken about this a lot, so I'm not going to go into that, or regulation. But I think funding is a really interesting one. So the idea that from an IPO perspective, so we do a lot of work with investment banks, the thing they're really worried about is the idea that companies in the future simply won't IPO anymore. And you had this with Spotify, where they went DPO, so direct public offering. What does this mean is you don't give a nearly big enough fee to an investment bank, so they have to come up with another form of revenue stream. And then switching, we've spoken about customer switching at great lengths, a really important idea of brand loyalty, where that sits now and in the future. And finally, talent. And I think talent may be the most important one, particularly for incumbents. So, for example, what happens if you as a bank can no longer incentivize your staff to work for you based on purely financial means? And this is super interesting. This is the idea which I don't think has happened in banking in a while. What happens if they're no longer just there for the bonus anymore? So do you become a purpose-driven organization? How does that change the type of products you offer? So finally, so what does this mean? So this is where we got to the most interesting element, I think, which is understanding, okay, so where did we think disruption will happen next? So if you look at this 2x2 matrix, you've got the enabler maturity. We talked about what those enablers were going down the x-axis. And then we've got customer appetite on the y-axis. So we thought broadly transactions, mass market savings, responding to ongoing disruption. So that's kind of been talked about already today. We've spoken a lot about transactions. But actually the really interesting space and the place where we thought was a £54 billion opportunity, and I will repeat that opportunity because a lot of our clients have read our report, which says the overall number is close to 104 billion, and said we're going to lose 104 billion of revenue over the next 10 years. But in fact, this is just opportunity up for grabs. And so where do we see this? So why do we pick SME lending? So again, for each of these use cases, we took real-life cases. So we took real-life cases in alternative markets and see how far they got with disrupting incumbents and how quickly. So SME lending, so we looked at China, looking at Baidu, et cetera, and how quickly they had gained almost a 10% share in SME lending. From a personal insurance perspective, I think this is super interesting. We've got a great fintech in London at the moment called Cover, where you can insure your car by the hour than rather by the year, fundamentally changing the assumptions around this. Commercial insurance, again, thinking about, okay, so 80% of commercial insurance is still sold through a broker. That seems madness to me. Like, how can you disrupt that model? And then finally, life and pensions. Again, we've already spoken about this, but this is fundamentally changing, and this is largely due to the 2015 regulation change, but also technology and also the workforce which is now investing in this. So this was one. So what we thought was going to happen next. And then obviously, when you say what's going to happen next, you have to start putting a number towards it, and you have to say who the likely winners are going to be. So what you're seeing on the left-hand side is, your left-hand side, am I right, is as a percentage how much of revenue we think is going to be disrupted within these individual product lines. And then within those, the likely winners. And again, we define those likely winners by defining, okay, so what are the key characteristics of your new entrants, your adjacent players, your incumbents, and where do we think they could best serve their clients in the future in 2030? And then you get to this total revenue figure of roughly 106 billion. So I think overall, I was asked here today to present our study, but more importantly, this is really the first round for us on this piece of research, and I would really encourage any questions around this, any challenges, the fact you hate it, the fact you disagree with everything I've just said. That would be great, because I think it's not my job to stand in an ivory tower and say, oh, this is what I think PwC says, so you should all listen. I think it's more in terms of, do you agree with this? And actually over the next 6 months, this is more of an iterative process in understanding what does the future of financial services look like, not just written by us, but also written by our clients.
Plenty of time for questions. So if you've got questions on Slido or you want to get a mic, then thanks very much. That was a wonderful presentation, and I'm sure people have got a lot of things to ask you.
Any questions?
One up here.
Hi there. Good morning, Ross from Skybound Capital. I can agree with your SME lending increase over the years, do you not feel that it's somewhat the same as maybe the 2008 financial crisis with the property? What are the risks you foresee in the lending space that could potentially blow up?
Well, I mean, I think, interesting question. I mean, I think there's a certain thing around proving, and I think in terms of, so like Alipay and Baidu do some really interesting things about how you define lending by a credit score perspective and not using credit scores. So everyone know Credit Klarna, this idea of you lend immediately based on people's user history on the internet. I think the interesting thing about all of these things and these innovative ways, and I think they're definitely a step in the right direction, but the concern is the historicals are not there. So what happens, as you say, like 2008, when something breaks your models? I think that's an inherent risk, certainly. And then more importantly, and I think we're seeing this, there's almost this backlash to a certain extent around fintech when it stops being the new shiny thing, is people start being really concerned from a regulatory perspective about whether they are actually adhering to the regulations in the same way that incumbents are. So for me, those are two key things. What's the source of our data? Many hours. We, so a combination of we ourselves collect primary data. We released a paper about mega trends a few years ago, so there's some internal PwC data. Also, externally, we do use a number of providers, but I mean, all of those information came from a variety of them. But in short, a lot of hours.
Any other questions from the floor? Yep, one up there. Thank you. Microphone, front row.
Yeah, go for it.
It's on the way.
Thank you. The first chart you showed the change from so many companies and so many brands down to the current financial services incumbents. If you were to predict what say just even the next 5 years would look like, who do you think are going to be on that list in just 5 years' time? And will it be things like you mentioned, the giant Chinese companies that have maybe taken over from some of our current financial services incumbents, or will it be the social media giants entering financial services?
I've got to be a little bit careful because I think all 6 of those are PwC clients. But in terms of who do I think could be a new entrant, yeah, I think your Chinese example is a great one. So I read a stat the other day that WeChat in a day logs more transactions than Amex, Visa, and MasterCard does in Europe, just in China. So yeah, I mean, that's happening already. From a who's going to disrupt the market further, I think we're kind of seeing it already. You saw with Apple launching their credit card with Goldman Sachs. I don't think we're going to get to a situation which I think some banks were nervous about a few years ago, where it becomes like they're just the piping in the background. I don't necessarily see that happening. But I do see certainly big tech being, and you can read the report, but certainly big tech being the winner, mostly just down to data. It's that idea of completing the circle. The winners, you say? Well, yeah, I mean, one of the winners, because it's that idea of completing the circle, and I am actually slightly stealing from the book The Circle at this point in time, but the idea that you can see both sides of a transaction, that's never happened in history. That's an amazing ability, the idea that you can see both how much people have in their bank account and also exactly what they're spending it on. Because you're Amazon, and you both see what they're spending it on, and you see maybe in the future what's in their bank account. Yeah, I think that could be, how do you compete with that? I mean, they will, but that's a fundamental disruption, certainly.
Do you think that's okay?
Again,
There's only one answer.
No.
I don't like the pause.
Yeah, I would personally not be comfortable. I think there's certainly some advantages of that, but no, I wouldn't. But I mean, commercially there are advantages, but personally, no, I would be deeply uncomfortable.
Couple of hands up there. Microphone.
Hi. I just want to ask you whether you think that these new technologies there's a risk of them disturbing the banking industry, especially given, for example, things like Revolut or Starling that offer bank accounts. So they're kind of removing, in some way, currencies from current accounts from the traditional banking service, and it's reducing their revenue. So do you think that they have there is a risk to the banking system?
The incumbents?
To the incumbents,
Yeah.
or the banking system, yeah.
I think, 100%. But I think there's always an entry, and the thing we really, and I actually wanted to focus on it much more, but I got poo-pooed by my boss, around trust and how important trust is with incumbents. So, for example, how many people in the room have a Challenger bank account? Put your hands up. Okay. Now, keep your hands up if you get your salary paid into that bank account. There we go.
Not
Like,
yet.
yeah, well, no, but like it's an important thing. I think trust has such an important part to play. And even though like the FCA guarantees your first 75K, and I'm not sure how many people, but I certainly don't have 75K in my bank account. So theoretically, I should trust them because my money's guaranteed, but yeah, I still don't. Even though I work in disruption, and I think that's so interesting, and I was a bit worried about doing that in this room because you may have kept all your hands up. But I think trust, for example, is a very difficult thing to harness.
Stickiness.
Yeah, stickiness as well.
There's another question over the other side.
So we all know that obviously the US dollar is the dominant currency at the moment, and you had this graph, and you did express your opinion that you don't want that to change. Could you explain why, please?
Oh, the US.
The US dollar as a currency. So you said there are other countries who are trying to intervene and make their currency more dominant. So we all know that if we operate in a monopoly, right, there is lack of competition, there isn't much progress. But you kind of confirmed that, do I want that to happen? And you said no.
Oh, right. No, sorry, I didn't mean that. Thank you for correcting me. No, I think it would be great if we had more than one. And I think, like, particularly cryptocurrencies, but also, like, Russia's been a proponent potentially through a key advocate for this, potentially through necessity. No, I think it would be fantastic if we had multiple global currencies rather than, because as you say, like, monopolies are never a good thing. Yeah, for sure. Thank you for clarifying that.
Okay, let's take the last question over the other side of the room. Have you still got your hand up? Yeah, thank you.
Thank you very much. Just to go back to the idea of trust, one of the things that banks always play on is this idea of trust and that you become a long-serving sort of customer. And it's become a bit of a currency, as it were, especially for some of the much larger banks, if you look at the Japanese mega banks. Given that trust is earned over time, can you imagine a position whereby the infrastructure put in place by challenger banks will allow banks to be able to give much higher rates of interest because they don't have to pay for global offices around the world? And if that was to happen, how quickly do you think the trust would be eroded from the larger banks and be placed back in the challenger banks on the basis that actually they can give a better economic return to their customers?
That's a really good question. I think, and actually if we go back to that thing, it doesn't work. But we kind of split consumer value and trust in half in the middle because we thought they were the kind of the central points. And I completely agree with you. Trust only goes so far. If it's not commercial, it's not commercial. And I think particularly with like the freedom of information and the ability to look across like, any supermarket and your insurance being like the obvious one, but like it's so easy to check that, I completely agree with you, trust only goes so far. I mean, it is trust, but it's also a little bit laziness as well. So it's just churn rate in terms of like, there's only a certain amount of bank accounts a year which are susceptible to being taken by someone else purely because of that's how many come up each year. And yes, more will come up if you lose trust, and there are examples. of incidents in the media recently, particularly around IT, where systems go down and you have a mass exodus. But as you say, I think, no, 100%. If you can offer the consumer more value, then trust will only keep them there for so long. And I think that time is certainly going down.
Well, thanks very much, Arthur. That was an absolutely fascinating presentation.
Thank you.
And I commend everyone to read your report. That's how I found Arthur. I read his report and I thought, oh, that looks interesting. I'm going to get that guy to the conference. So really appreciate it. Thanks very much.